What happens to interest rates during a recession? A contracting economy might have a lot of financial consequences for you. One major concern is what happens to interest rates during a recession. Normally, interest rates fall in the early stages of a recession to stimulate spending and borrowing. Lower interest rates can be beneficial if you need to borrow money, but they also have a negative impact on how rapidly your money grows in a savings or CD account. During a recession, a financial advisor may assist you in making wise decisions. What exactly is a recession? A recession is characterized by an economic downturn. The exact definition is at least 2 consecutive quarters of negative gross domestic product growth, GDP. However, the term recession is frequently used in a broader sense than that formal meaning. The National Bureau of Economic Research, NBER, for example, defines a recession as a major economic contraction that lasts more than a few months. When there is a recession, unemployment tends to rise as economic activity and output stall. Companies lay off workers to maintain profit margins. Meanwhile, people who have been laid off prefer to save money and spend less on non-essential goods such as trips or new automobiles. Recessions are a natural component of the business cycle. There are moments of expansion when the economy is thriving in this cycle. The expansion era eventually comes to an end, and a time of contraction follows. This is when a recession occurs. There is a trough in the cycle where the economy reaches its lowest point before the cycle restarts with another growth period. Recessions, what causes them? There is no one cause of recessions. A recession can be induced by a variety of factors, and there is no way to forecast when one will occur. The following are 7 common reasons of recessions. Geopolitical developments that contribute to increased stock market volatility. Pandemics worldwide. Natural calamities that cause widespread economic disruption. Significant decreases in consumption and demand. A decline in market and economic confidence. Stock market bubbles. Excessive interest rates. Whether or not a recession is short-lived is usually determined by the circumstances that precede it. The Great Recession, for example, lasted around 18 months. The subprime mortgage market crisis, which resulted in a housing market catastrophe, was substantially to blame for the recession. Each recession lasts a varied amount of time. How do interest rates change during a recession? During a recession, the Federal Reserve utilizes monetary policy to control interest rates. When a recession occurs, the Fed may lower the federal funds rate to stimulate economic growth. The federal funds rate is the overnight rate at which banks lend money to one another. When the federal funds rate falls, banks and lenders usually change loan interest rates correspondingly. Borrowers will pay less for loans and lines of credit as a result. The theory behind this method is that if credit is easier to obtain, more people would borrow. As they spend what they borrow, they put money back into the economy, helping it to recover from a slump. While reduced lending rates are beneficial to customers, there is a drawback. Banks can reduce the interest they give to depositors when interest rates fall. During a recession, deposit accounts, such as savings accounts, CD accounts, and money market accounts, often have reduced interest rates. This is a drawback if you want to expand your money. This is a drawback if you want to develop your money quickly. Dropping interest rates is more prevalent in the early stages of a recession. As the economy improves, the Federal Reserve may change its interest rate policy. When the economy approaches the pinnacle of an expansion cycle, the Fed may raise interest rates to reduce borrowing and spending. Typically, this is done to keep the economy from overheating.